In addition to credit score, I know one of the other things that you're looking at is the debt to income ratios.
Correct.
And you look at that not on a yearly basis, but on a monthly basis.
That is correct. And so ideally, the best debt to income ratios are 28% housing ratio and 36% total debt ratio. And let me explain what that means. So every dollar you make gross, 28 cents of your $1 should go to housing or less.
Okay.
And 36 cents of all your debt, including your housing payment, credit cards, car payment, shouldn't exceed 36. Those are ideal numbers. If we had those numbers back before the mortgage crisis, we wouldn't have been in the mess we are in today.
Right.
That we experienced.
Yeah, I want to make sure that, when we're off camera, you tell my wife that too.
Okay.
So, but for, some of those people that, don't quite have the perfect debt to income ratios, you do offer some programs that would allow a little bit higher debt to income.
Sure, everybody's lifestyle is different. I've had people pushing near 50% debt ratios, but they're happy, they're living within their means, they don't need the steaks, hey, they're happy with a bologna sandwich, and right. they want a nicer property or nicer,
sure.
higher mortgage payment. You have others that, hey, 18% or 28% on a housing ratio, that might be too much for them because they like to travel or these.
Sure. Yeah, and there's certainly circumstances where you approve somebody to X amount and, they're not necessarily comfortable pushing the limits that much. They're going to buy a much less house, be a little bit more comfortable in where they are.
And that is those are the borrowers we really appreciate.
Sure.